Hello everyone and welcome to the final webinar in our series of 10 with Clive Lambert from FuturesTechs. What are we going to look at today, Clive?
What does everyone want to look at? That was what we always advertised this as, which was a bit of a sort of a free-for-all, if you like. We could look at current markets. We could, there's a few other bits and pieces that I think people were interested in looking at. Fibonacci Extensions was one of those, I think, so we could start with that. The other thing I thought I'd do is a couple of weeks ago I was asked to present a quick 10-minute snapshot, a review of 2017 and an outlook for 2018 on various markets, which for the Society of Technical Analysts, and I did that, and I have the slides for that, and I thought maybe we could share that as a bit of a parting shot for our series of 10 webinars. And look at some crypto charts, because that seems to be on everyone's ears, although I think actually the bubble might be elsewhere, the way things are looking at the moment, and we'll discuss that as well.
Fantastic. I think you're right there, Clive. I think it is very much, at the moment, it's very much crypto, and I know that you and I spoke earlier, it's equity markets are looking bubble-like.
Yes, it does seem that way, and I've got my phone ringing, which is a bit annoying. That's all right, it stopped. Right, okay, well, let's
over to you, Clive.
Then. Yes, we'll do the old without further ado thing and crack on. So, yes, that was that's my rather tongue-in-cheek agenda for today, a blank canvas, if you like. So yes, please do, if you have questions, just put them on the questions tab on the GoToWebinar dashboard that you've got in front of you, and or any markets you want to look at, and we shall get round to that during the next 45 minutes to an hour. I was asked by somebody last week if we could look at Fibonacci extensions and what happens when markets are at new all-time highs and you know, and there's no resistance, if you like, which is obviously quite relevant right now, because we've got that situation in some of the equity markets. We've also seen that situation, although it does seem a little bit like ancient history now with some of these cryptocurrencies, and I've got a couple of interesting charts from that sphere as well to share on this front. Now, we looked earlier on in the series of webinars at Fibonacci. We looked at the idea of Fibonacci retracements, that if a mark that, you know, and the symmetry of the Fibonacci numbers and how they seem to have a prevalence and a relevance in financial markets. But yeah, and so yes, the retracements we looked at. Extensions we didn't look at, and that's the idea that Fibonacci can give us upside projections, if you like, when markets are trading to new upside levels. Obviously, the opposite can be said for if a market is trading to new all-time lows and you're looking for downside levels to reference. But I think in where we are right now, it's the upside ones are the more interesting ones for various markets. So I'm waffling. Let's get on with it. And here's a few slides that I've ripped out of one of my support and resistance seminars that I deliver for various people and have done for years. What happens if we're making new all-time highs? This was a chart for the FTSE 100 actually, and this chart right here is the FTSE from around 2015, and then we made a low in 2016, traded up within a few months from about 5,400 to 6,400, and then came all the way back to here, rallied up to 7,000 again by October of that year, and then had this drop, which was I think it was Trump getting in at the end of 2016, and then the market off we went again. And when you are, and so what we do here is we measure from here to here. which is the first wave of that. We're saying that this is 1, 2, 3, 4, 5 waves basically. Okay, like an Elliott wave structure. And if we measure wave 1 and then add that measurement from the bottom of wave 4, then that gives us, and that gave us, an upside projection of 7,600 for the FTSE. That was on the daily chart. Now, what I'm going to do with the next slide is just look at this last bit here, which again you can see is 1, 2, 3, 4, 5, potentially a 5-wave structure. And this, we did the same thing here. We measured from the bottom of there to there, which only took 2 days because it was those wild moves when Trump became president. And then we rallied up to 7,300 by the beginning of last year, and then in February of last year we pulled back, and that was the end of wave, the corrective wave 4. And then we measured there to there and put that from there to there, and that gave us 7,560 for the FTSE. So if we put them together, and then we've got another measuring technique is to measure from the bottom of wave, the start of the structure, which is here, to the top of wave 3 here, and then put that projection, put the Fibonacci projections from the bottom of wave 4 to give you upside levels on wave 5. If we put them all on the same chart, what that suggested to us at the time was that we had a confluence of Fibonacci projection levels around 7,600 to 7,650 for the FTSE. And now this was all done last year for a seminar I did last year. So last year, this time last year, I was saying using Fibonacci extensions and projections that the FTSE had potential to go up to 7,600, and it was at that time around 7,300. Well, what we know now in hindsight is that the recent high in the FTSE is somewhere around 7,700. We're currently trading just below those highs. So we've hit this area of resistance and actually seen a bit of a stalling. So it's interesting that maybe that has come good, if you like, with respect to the FTSE. If we look at the S&P, and again, this was me looking at the S&P and doing the same sort of thing. We're measuring from here to here and projecting that from here up to here. And then we're doing the same with a smaller structure within here. And that suggested that, look, we had this one here and this one here and another one here that were all clustered around 2,800 for the S&P. And 2,800 in the S&P. Well, we now know that is basically where it got to, where we are currently. Basically, let's put the S&P, and here's my current charts. Yes, we're 2,842 was the overnight low, the overnight high, a new all-time high for the S&P. And now my Elliott wave work and my Fibonacci projection work has got the next upside targets here at set 2,925, and then another target here at 2,955. So what this is saying is, if the market does follow these natural beats, these Fibonacci based natural beats of the market, if you like, then we shouldn't be so concerned about 3,000 as the next level of the S&P, because actually there is some big resistance coming up at 2,925 and 2,955. And then there's another thing we can say about this, is that actually, if we look at a daily chart for the S&P right now, it does appear that things are sort of, they're going parabolic a bit, if you like. We are just starting to rise quite significantly. But if we look at this monthly chart, we can say that having got through 2,788, which is this green line here, and also before that getting through 2,711, which is that 61.8 projection there, now we're above there, these two. The next resistance of any note is 2,925. So even though the market seems to be shooting up a little bit fast at the moment, well, there may be a good reason for that. It's because there is no resistance until we get to 2,900. Okay, so as much as you may be thinking, crikey, George, this is getting a bit carried away with itself, when's it going to stop? Well, that chart just on its own says to us there's nothing to stop it going to 2,900 pretty quickly. There's nothing in the way, if you like. So yes, that is my first point, and we'll go back to our slides for a minute and see what else I've got to say here on Fibonacci extensions. One of the charts that I'm going to show in a minute in my presentation that I did for the STA, and one of the things that I think I may have shown on here a few weeks back, was the chart for Ripple. And what I did with the chart for Ripple was to try and come up with some upside extension targets, if you like. And I had measured from this low here, which was around 19 cents, I think, right here, to the top of this this candle here. And then I projected that from this low here to give upside projections, which one of those was 3.38. Okay, $3.38 for Ripple. Now, if we actually look at the chart for Ripple, there's that 3.328, and there's the high. On that day, back on the 4th of January, the high for Ripple was 3.32 or 3.317, and I had this Fibonacci target of 3.328, which is, I think you'll allow me, I think we can fairly say that that was a useful piece of information at the time. And on that day, we posted a great big doji candlestick as well, another warning sign that maybe we've just hit this Fibonacci level and we have and we've posted a doji candlestick. And this isn't me doing Harry Hines site analysis now, because I was tweeting this and I was talking about it on this webinar, and I was talking about it to my colleagues at the Society of Technical Analysts on the presentation that I think now I am, with a lack of questions happening, I might as well crack on and give to you. And I will just say though that this is arguably 2 weeks out of date, but I think it's still got some relevance because it's basically meant to cover thoughts for the whole year. So so hopefully it won't feel too dated, because it is literally only 2 weeks old. So yes, this was my brief, was to, in 10 minutes, do a review of 2017 and then give some sort of outlook for my thinking on various markets for 2018. And so this is what I put together. Tried to sum up 2017 in one slide, which was that Donald Trump, stock markets were rallying on the tax bill and Donald Trump, and you get the Donald Trump tweeting every time the Dow hits another double, another level with noughts on the end. QE, the central banks have been, pumping money into the system, and that rolls on with very few exceptions. Obviously, now we are seeing the US winding that down. That meant that bond yields have stayed historically low. The other headlines of most of last year, from if you're reading newspapers and trying to look at fundamentals, is that we're bungling Brexit, and I very much challenged. Well, the charts are challenging this idea that Brexit is a complete and utter mess, and that that it's a complete and utter disaster, because actually the FTSE 100 and the FTSE 250 are making, or aren't far away from, new all-time highs. They're just off of all-time highs on both of those indices. And I remember at the time that the FTSE 100 was flying high, that a lot of people were saying, oh, it's because of the weak currency and and because most of the FTSE 100 is made up of overseas companies, so it's going to make their results look better, Well, yes, I think that was a reason that was attributable to that move, until you look at FTSE 250, which is the next 250 companies, the biggest companies in the country, and most of the FTSE 250 are companies that are doing stuff in this country. That's made new all-time highs. Gilts at the same time, the bond market in the UK is showing signs of topping, i.e. yields are bottoming, i.e. and also, you know, you see that as well with the short end, the interest rate futures, which is suggesting that we are on the cusp of a change of interest rate policy, and we can start seeing rate rises in the UK more and more. And cables staged a strong recovery from that Brexit, you know, from its Brexit woes. Is it enough? Was the question I was asking 2 weeks ago. 2 weeks on, you could argue, well, we've just hit 140 overnight. So yes, I think it is at the moment. The euro had a strong year as well, and that's continued in the last couple of weeks. The dollar index, the US dollar against the basket currencies, dropped from 103 to 90 last year. Gold is always of interest to people. That has been weighed by a strong resistance at 1380, and that continues to be the case. If you are an operative in the oil market or interested in oil markets, you would note that last year was a bit of a game of two halves, and I'll show you a chart about that later on. And then everyone went crypto crazy, and the big question is whether that is a bubble or not, and I have some very strong views on that, let me tell you. So let's debunk a few misconceptions, if you like. Okay, one of the things I was putting on my reports recently with respect to the S&P and the Dow, and the chart we've got on the screen there is the Dow, is that RSI on a daily, weekly, and monthly time frame was overbought. And in fact, on the daily time frame that we've got in front of us there, it has recently reached its most overbought reading ever, reading 88. Okay, it says 87 there, but we've since gone on to print to read 88 on that, and now come off a little bit. Okay, it's the most overbought we've ever been. But see those three orange arrows on the chart? They're the other times when RSI got very, very overbought. And what does history tell us about subsequent price action on those occasions? It tells us that it's not really that significant, and it isn't that trend changing. This was in 1986, and it took a year and a half and a big storm, and that was the start of my career in 1987, and there's the stock market crash of 1987. If you compare it to, you know, and I've got this on, you know, on a percentage scale chart, so you know, you can see how big that was compared, you know, in percentage terms. Obviously, the banking crisis of 2008 to 2009 was deeper and nastier, but over a more prolonged period, if you like. But right here, RSI was overbought on every time frame, and we did not see a correction. Didn't see much of a correction there, and took a year or two before we saw a correction on that one. So just because RSI is overbought on all these different time frames maybe doesn't really mean anything in particular. Just because Donald Trump's tweeting at you every day and telling you, God bless America, and I'm the best president in the world, and the Dow's just hit another round number, and it's 26,000 now, and we're flying, and we're great. See the two boxes that I've put on the chart there. The red box is the rise in the Dow since Donald Trump has been president. The blue box is the rise in the Dow whilst Barack Obama was president. And I'm not saying that I am a dyed-in-the-wool Barack Obama fan or a dyed-in-the-wool Trump fan. I actually personally am of the view that I don't live in the United States of America, and therefore I have very little reason to have anything to say about US politics. But that's just me, and that's a bit of an aside. I think maybe I should stick to looking at charts, hey? But it's just an interesting point that we're getting. I think that, you know, Donald Trump's the man that talks about fake news. Well, getting excited every time the Dow makes another 1,000 points, if you put it in percentage terms, like I have on that chart there, it's pretty minuscule what's gone on since he's been in charge compared to what went on when the bloke before was in charge. And another misconception that I've sort of that I thought it was worth highlighting is that this rally that we've been in, which has now gone on for 9 years, you know, since the March 2009 was the low, right? This low right here, March 2009, and there's a, you know, a lot of people say that, oh, this rally's been going for way too long, it's got to correct, it's got to correct. Well, the last rally of significance is I've marked it with that green arrow on the chart. That lasted 11.5 years, from January 91 to September 2002. So the argument that the current rally has gone on for way too long gets instantly debunked, I think, by saying, well, look at the one before that. That went on for 11.5 years. Now a quick look at bond markets. I've got 3 charts on there. The Bund is the top left, so it's the German or the European benchmark for government bonds, and it is one of those classic sort of bottom left to top right charts. The last 2 or 3 years it's gone sideways at the highs because basically yields can't go any lower than they are. Similar with all of these markets really. Treasury notes is on the top right, and that's the 10-year notes in the US. Similar looking chart. Gilts bottom left. And we've got an uptrend line that's now broken, actually, that uptrend line on the gilt chart. But again, we've got bottom left to top right. Yeah, we've got a market that's just been in one trend for 10 years, basically. In fact, it's probably about 30 years that it's been in that trend. Now, again, signs of topping out because it can't really go much higher. Yields can't go much lower. And the bottom right chart is December 2018 euro dollars, which is the interest rates in the US. And again, I highlighted an uptrend line on that chart, and again, right, what's happened in the 2 or 3 weeks since I did this is that line has broken, and so that is suggesting that we may see an acceleration of, because this is interest rates 100 minus the interest rate to give you this price. So this is saying, at this point, it was saying that 97.70 was the price. So it was saying we were going to have interest rates at 2.3% in December 2018. That's how the interest rate futures work. So the fact that that's breaking lower and doing so at some pace as well is a suggestion that yes, interest rates are on the rise in the US, and actually they may rise quicker than we had originally, or that we have been thinking. So that's something to bear in mind. Brexit bungling. Well, there we have 3 charts. Top left, the FTSE 100 showing a move to new all-time highs and nothing to worry about at all, according to that chart. We've got the interest rates for, again, I'm looking at the December 2018 contract for, on this bottom left chart here, short sterling. So that currently is 99.30. That was showing at the time. I can't. Where are they now? Let me just double check. I can pull this up very quickly on one of my other reports. Yeah, Dec 18, it's at 99.10 at the moment, so we've come down to sort of this area here. It hasn't moved much, but we are off the top, and the highs were back in 2016, and again starting to suggest that we've got expectations of rate rises in the UK going forward. And the big chart here is cable, and it's a weekly chart, and it's against the US dollar, so sterling against the US dollar. And there's 2 big events, if you like, that we can spot straight away on this chart, and that's this great big candle here, which was Brexit, and then this great big candle here, which was the flash crash type event that we had in October 2016 on that, when we actually finally bottomed out with that massive rejection of the downside that happened overnight on very, very thin volume. And if we put our Fibonacci retracements from the high there down to that low there, we can see there's a beautiful symmetry here. The 38.2 line was where we failed last August, September, and the 61.8 line was the high on the Brexit day, and it was also 150. We're now here. We have moved up to 140. We have got above that level there. We've got above the low prior to Brexit day, which was 138.36, and a big level. And that level had a say for a little while. The market rejected that when it first reached it, but has now pushed on through. Traded up to 140 today, so right where my mouse is, right where the cursor is there, somewhere around there now. We are seeing a bit of selling today. We haven't, we're at 139.20 at the moment for that, but we are. But the thing is, again, do you remember how I said earlier that there's very little resistance at the moment in the S&P until we get to 29.25? There's very little resistance in sterling above 140 because of the swiftness of the move the last time we were here, which happened overnight when the Brexit vote came out. So what that's suggesting is that the path to higher prices for cable is a pretty clear path. And that should be borne in mind, I think. So according to the charts, no, Brexit's currently, according to the charts, and obviously the charts can change and sentiment can change, but right now the charts are saying that sentiment is leaning very much towards the idea that Brexit might actually be the best thing that ever happened to the UK. I mean, history will tell us that, of course. And obviously, as I say, charts can change. The euro, as in recent days, traded up to 123. So this is the weekly chart here. We've moved above 120.89, which was a Fibonacci level again, and we're up to here now, and we're looking for this 126 level next. And this chart on the right hand side is the dollar index, and that has that had a really strong amount of support around 91, and has since dropped below that support area, suggesting that we're going to see further weakness in the US dollar going forward. Looking at commodity markets, the chart on the left is Brent crude oil, and the big line, there's a couple of trend lines there, and the trend has got stronger over the second half of 2017. I said it was a game of two halves. This was the first half, just dampness and weakness. This was the second half of 2017, a really nice strong move. We've since taken out this high from 2015 at 69.63, and we are now eyeing up this level at 71.40, which is the 50% retracement of this whole move from there to there. So Brent crude oil markets are looking very strong still, and there's very little sign of them turning around, and I like them at the moment. I like oil. I also like gold, but it's been messing around. Gold looks like it's based, okay, but it has a problem, and the problem is 1380, and it's this 38.2% retrace of here to here. That's the move from 1923 in 2011 down to 1045 as we ended 2015. We then rallied sharply, and look at that beautiful hit and failure at the Fibonacci level 1380, and we came all the way back to here and then had another go at it last year. Got the 1372, I think it was, didn't like it, came back again. But now, in recent weeks, we have been heading higher again. Gold is currently 1336. We've got a gap above at 1347. Above that, we've got 1362. Above that, we've got 1372. And above that, we've got 1381. If we can get through all of those, then gold can go at 1588. That's what the charts suggest to me. And I think that's a move we could see this year, but we have to be patient because it is still sitting below that major resistance area. So still a bit to do for gold before it convinces. What's happened here? This has moved on me. Let me just fix this up. My chart's done a wobble and it's moved on me, so let's try and get this back, shall we? Right, here's my crypto craziness chart. And again, 2 weeks ago, Ethereum was up at over 1,000. Bitcoin was at 17,000. Litecoin was at 300. and Ripple was had just hit that 338, 337, 338 level that I was talking about at the time. And I don't know whether I've got any commentary on this. I finished by saying the crypto bubble might not be over, but it is tulips. Right, this was my summary page 2 weeks ago for my talk to the STA. Stocks are still going up. Why fight it? It does look mature and surely due a correction. I do think we're going to see a correction in equity markets this year, and I do think that the faster they go up, which as they are at the moment, then the sharper that retracement correction can and will be. Bond yields remain low. What happens when QE ends? Big question that, has QE created a bubble in itself? Have the central banks created the biggest bubble of all time? Forex majors are at key levels. We should get a decision in the next month or two. That's interesting because it will appear, that very much at the moment it looks like dollar weakness is here to stay. Gold and oil looking bullish. They still are 2 weeks on and have done for a while now. And yeah, so tulips. What am I on about tulips? What is tulips all about? Well, I don't know whether, for those of you who have sat through all of my all of these webinars, I'm sure I may have mentioned those flowers at some point. If you took up the offer to go onto my website, then you've probably had a sniff around the website, and hopefully you would have seen my blog on cryptocurrencies that I did back in December, in fact. So let's, in case you didn't, let's go on to FuturesTechs and let's go on to the blog. Come here, you blog. Crypto charts for your thoughts. Right. So this was my 8th of December blog. Time for me to break my silence on, it's Bitcoin. And I showed a chart. First chart was this. Something that is, as I say, it's been bumbling along for a long time and then went parabolic. What was that chart? Looks a lot like some of these crypto charts, doesn't it? That is actually a chart for silver back in 1980. And two guys called Nelson and Bunker Hunt cornered the silver market in the US and sent silver prices skyrocketing. And then the exchanges changed the rules, and they went from being the richest people in the country or the world on paper to being bankrupt within 6 months. And this is so that's silver in the 1980s. That's the rest of the story. It got to here and then it fell right over. Okay, and so when charts and the lesson from this and the lesson from all of these, and it's always been like this, is when charts go parabolic, they are going to fall over again. Okay, there's a lovely picture of some tulips because this has been going on for 400 years. Tulip mania. Look it up on Wikipedia if you want to do some reading on it. It's really interesting. It was there was a asset price bubble in the price of tulips 400 years ago. So we're just not learning. We're making the same mistakes over and over and over again. And for me, cryptocurrencies equals tulips right now. There's Ripple, what's happened since. Okay, we topped out at 330. That was at the start of January. We haven't even finished January and we're down at 125. Okay, that is a huge reversal of fortunes, is it not? Okay, and arguably this is saying to us we can go all the way back here to 25 cents. Okay, sorry, but that's what these charts are saying to me. If we want to look at some other crypto charts, I can show you, right? So, but look, this is Bitcoin, and this blue line, if we close the chart up, this blue line joins the low from July 2017 to the low from September 2017, and the third hit was the low a couple of weeks ago. Okay, and that blue trend line is currently at 9492. That low there was 9005. The 61.8 retracement of what move. I've made it. Have I made a mess of this? I've got a 61.8 retrace here, but I don't know what I've. No, I think I've got that wrong. Probably need to move that, baby. Sorry about this. Must have been some other work I was doing or something. Let's just get rid of it actually, because it's not helping us at all. Or is it that one? Might be that move there. That is at 9,500. So there's a bunch of things there that are saying that that 9,500 is a really big important area for Bitcoin. And if we go below 9,500, we'll go to 7,900. And if we go below 7,900, this chart says we'll go to 5,500. And if we go below there, we go back to 3,500, 3,200. That's what these charts are saying. Plain and simple. If we look at some of the other coins, I've got my, where's my chart that has them all on there? Build me some charts. Ethereum has been the one that has been remarkably resilient throughout this. And actually there's a sensible trend line, if you like, that says that we could go back to 640 without and going back to 640 is a return to normality, if you like. We've got a Fibonacci retracement level at 672 there, so I'll be interested to see what, if this is a genuine thing that's going up, then it will hold this area and then it can start going up again. If it breaks the 600s, then it's over. Ripple looks like it's over already. Litecoin is just about holding on to 170, 160, 170. It's had a few very nasty dips through there. Again, Fibonacci says that 162 is an important level, and every time we've dipped through there, we've recovered quickly. We're having another look at that now. But I think actually, if we're talking about bubbles, then this, there's your S&P monthly chart. Let's try and get a cleaner weekly chart. There's the weekly chart, and here's your daily chart, and that looks to me like something that needs a pullback as well, and is arguably more of a bubble than crypto, because arguably the bubble has burst on crypto, if you like. Quite often get asked about the DAX on these pages, and the DAX, the all-time high in the DAX was on the 7th of November, and I look at the futures and it was at 13,355, wasn't it? 13,533, sorry, 13,500. Yesterday we got up to 13,515, so just a few ticks shy. And today we opened higher, we gapped higher, and we traded up to 13,596, a new all-time high for the DAX. And then we pulled back. And let's have a look at the 30-minute chart for this. This is interesting stuff. We were talking about gaps on one of the webinars. Okay, here is the DAX half-an-hour chart. Let's clear down some of this stuff just to make it a bit clearer for us. We'll remove that and we'll remove that for now. Okay, so there's the gap this morning. Okay, that was yesterday's high in late trade. This was yesterday's high during the day session. Okay, so do you remember how I was talking about day session gaps being important as well? Well, it's held the first one. It's held the all sessions gap. It held 13,515, and it's rallied off of there. Only 20-30 ticks so far, but that's bullish price action for now that we've held that gap. We probably should do a need to go down to at least 466 and then see if some buyers return there, because that's the real gap, if you like, because that's the gap that's this is just after hours. This is US exuberance after we've closed in Europe, if you like. So interesting little gap play that unfolded this morning on the DAX that I thought was worth highlighting as well. I have done rather a lot of waffling on. I'm just going to pause for a second to drink some water, if you don't mind. and ask if anybody has any questions or any markets they wish to look at. Roll up, your time is now. It would appear not. We've got a very happy crowd.
I'm sure
Go on,
some.
Chris.
I'm sure some requests will come through, but I think we're on a slight delay, aren't we? There you go, Clive. So, yeah. There you go. One's come through.
There we go. So Jackie's asking if you could only trade with one technical indicator as well as the candlesticks, what would you choose? Oh, Jackie, I like that question. It would be market profile. It would be the volume at price stuff. So you can see where value is, like this DAX chart here. I'm talking about this volume at price histogram on the side here, because that gives me extra information that I don't get from the price chart, because it tells you where most of the volume has gone through or where very, very little volume has gone through, and you can get some extra, you know, some extra color from that you just wouldn't get from the candlestick chart. Here we go, we're coming through. What other indicators can be used similar to market profile in the absence of market profile? Right. There isn't anything really that is close to it. It's very much on its own, I'm afraid, Nigel. I think obviously you're but you can get volume at price data on for a reasonable cost on the TradingView platform, which is this here. And if we look at I'll just show you. Because I think I had it on that Ripple chart, didn't I? Oh, come here, you silly machine. Chart and Ripple. Okay, so what's happened to this chart? It's gone completely pear-shaped. Oh, there we go. Okay, yeah, this is the volume at price here. Okay, now obviously this is, let's move it to get rid of that data, so it's just showing us what we've got on the chart. Okay, there we go. Ripple volume at price, actually suggesting that a dollar is a high volume node and a natural place where support and buyers might turn up. More volume's gone through here, 80 and a dollar, than any other prices for this particular thing. Okay, that's the volume at price extra clue, if you like, that it's giving you. So what have we got? We've got another question here. What are the three best indicators to use together? Depends on the market. I use different indicators for different markets. I would suggest that obviously you've got the two I would immediately have. A rather tongue-in-cheek, facetious answer I always give to this is price is the key element to any chart. You don't want to have too many indicators on a chart, because it will start to make it a mess and cause you bother. I am a fan of RSI. I'm particularly with looking for, you can see that most of my charts here, I've got a daily time frame there, 30-minute. I've got 4-hourly chart there. I've got RSI on most of them. I like RSI, and I like things like, I'm looking for divergences and things like that, looking for when things are going overbought and oversold and coming out of overbought and oversold. I'm a fan of the Fibonacci levels on there, and find a reliable moving average. There's an interesting one, and actually I did some work on Bitcoin the other day. I was looking for the reliable moving average, maybe, that could really cut out the noise, but and sort of came up with 120 days as something that might be a useful indicator if you're trying to take that big step back and look at the bigger picture. And so, yeah, but it's very much market specific, and some different markets respond to different things. I find that market profile, the daily market profiles work really well for bond markets, for bond futures, but maybe not so well for commodity futures. It is market specific, basically. Best strategy for beginners. Good question. I think the best strategy for beginners is read a lot, draw horizontal lines on your chart, and look for and look for interactions with horizontal lines. Just stick to horizontal lines to start with, and try to learn, and try and stick to one or two markets, and try and learn the foibles of your market. Yeah, so instead of trying to look at every forex pair in the world, maybe as a beginner you are better off saying, I'm going to look at Euro US dollar, and I'm going to look at Brent crude oil or something. Two different markets, and try and learn their behaviors, and learn the times of day when they're busy, and learn the events that happen over a course of a week that could change things. If you are trading oil, you need to be aware that 3:30 on a Wednesday it all goes off, because it's the weekly inventories report. There is no point in trading 100 markets and then suddenly you've got a position in oil at 3:30 on a Wednesday one day, and you go, oh, that's just moved a lot, what happened there? You know, you should be aware of these things, and you only become aware of these things when you're learning to trade by, I think, you know, really focusing on specifics. So I would say focus on one or two specific markets would be some advice for beginners. Kim's asking, there we go, Chris, coming think fast now. Spoke about volume and profile last week, and I was mentioning ABC. However, in TradingView, we see numbers. Can you explain how these work? Can it be read? Kim, I think this is just, I don't know. I haven't actually used the TradingView profile tool. But yes, different charting systems use different protocols. Bloomberg's is different as well. I think between us, that's because CME, the exchange in the US, has a copyright on these things, and various firms try to get around the copyright by doing profile a little bit differently and saying, oh no, it's not market profile, it's something else. Yeah, I think you may be able to press help, or there should be some, you know, on most charting systems there's a help button, and there's lots of text behind it that can help you to understand the specifics of that. Right, we're getting close to the end of this, I think, guys and girls. So should we make this the last question? Best book on technical analysis is clearly Candlestick Charts by Clive Lambert. No, it isn't. It is. It is. Oh, what is it called? I've got it over here. Technical Analysis of the Financial Markets by John J. Murphy. There's also another similar catch-all technical analysis book by Messrs. Edwards and McGee, and I would strongly recommend that. The best book on candlesticks is by Steve Nissen, Nison, although that's yeah, my one's in color, but his one is the definitive text, if you like. I've got a recommended reading list on my website, I think, actually, and so that's probably, I should have said that ages ago rather than just waffling on like I have been. But you know, I think you're used to me waffling on by now, aren't you? Let's have a look. Is it there? Here's my recommended reading list. So there's Murphy, there's Nissen. If you're interested in the cloud charts, this book by David Linton's very good. If you're interested in market profile, then Mind Over Markets is about the only book you've got for that. We didn't get into Point and Figure, but The Definitive Guide to Point and Figure by Jeremy Duplessis is an excellent book. And if we're just talking about general books on the markets, Reminiscences of a Stock Operator, highly worth a read, and I reread that once a year myself. And another book I reread every year is Market Wizards, Interviews with Top Traders by Jack Schwager. That is, those two there aren't about technical analysis, Reminiscences and Market Wizards are not about technical analysis per se, but as far as I'm concerned, they are the best two books on markets. And the other thing about Reminiscences is it's a cracking story as well. So it's actually quite an engaging read, I think. It's a bit of a history lesson and a bit of a narrative about the life and the ups and downs of of one of the most famous traders that was ever known, basically. Chris,
Clive,
it's
thank you.
it's that time of the hour where we sort of got to wrap things up, I think, isn't it?
It sure is slightly emotional being the
Oh.
last webinar. I think I've certainly really enjoyed the series of 10, and I hope the people that attended have as well. Thank you so much, Clive, for sharing your knowledge and expertise with us. And hopefully we will be doing something in the near future.
Okay, well, thanks very much, Chris, and thank you for everyone for listening in and attending. And yeah, it's been a pleasure.
Clive, thank you very much. Take care.
Take care, everyone. Cheers.
Bye-bye.
Bye.